The AI gold rush isn't coming, it's already here. But while the world is obsessed with shiny new chatbots and image generators, the real winners are often hidden in plain sight. Subscribe to LuxFluent and join us as we uncover who's really profiting from this AI boom. Number 1. The AI gold rush. What's happening and why it matters. The term AI gold rush isn't just dramatic flair, it signifies the extraordinary surge in artificial intelligence reshaping industries, drawing massive capital, and generating fresh revenue streams. Over the past few years, emerging AI models like GPT-4, Claude, and Gemini have set off frenzied investments as organizations race to integrate capabilities in language, vision, and multimodal understanding. In 2024, global IT spending was projected to reach $5.43 trillion, with generative AI and its infrastructure driving a 7.9% increase and data center proliferation rising by an astonishing 42% year over year. The economic impact looms even larger. According to PwC, AI could add an extra $15.7 trillion to global GDP by amplifying productivity, innovation, and consumer experiences. That positions AI as more than a trend, it's a foundational shift. Still, just as 19th century gold miners often found more security in selling tools than striking gold, today's most stable and lasting profits are with those supplying the critical infrastructure, cloud platforms, GPU manufacturers, and API ecosystems. Even when trendy tools fail, infrastructure providers remain indispensable. Number 2. The layers of AI wealth creation. A clearer view emerges when we separate the AI ecosystem into 4 distinct layers. A. Infrastructure providers, the modern shovel sellers. Compute and storage form the backbone of AI services. Major cloud platforms, AWS, Microsoft Azure, Google Cloud offers specialized GPU and TPU instances designed for AI, metered on consumption or subscription. NVIDIA, which commands around 97% of the AI accelerator GPU market, designs the chips powering most large-scale model training and inference. Its data center revenue has surged, growing by over 427% year over year. 427% year over year, from around $4.3 billion to more than $22.6 billion in just one quarter. That explosive foundation is mirrored across edge computing, cooling systems, networking gear, and data analytics providers. B. Foundational model creators. Beyond chips and servers, a second tier comprises those building the brains of AI. Entities like OpenAI, Anthropic, Google DeepMind, and Meta DeepMind invest hundreds of millions, often reaching $100 million or more, to train and refine models like GPT-4, Claude, Llama, and Gemini. Training GPT-4 alone costs an estimated $63 million in compute, and once all development expenses are included, training bills may top $100 million. Additionally, projections indicate that by 2027, frontier model training may reach a staggering $1 billion per iteration. These organizations must then monetize their work through API usage, enterprise deals, and premium consumer subscriptions, while balancing infrastructure, staffing, dataset procurement, and energy expenditures. C. Startups and application builders. Sitting atop these engines are startups delivering plug-and-play AI services to end users. Companies such as AutoGPT, LangChain or Langsmith, MindsDB, and Relevance AI exemplify this wave. They use APIs to create vertical assistants, smart chatbots, content generators, data analysts, tailored to specific industries. AutoGPT, an autonomous agent built on GPT-4 and GPT 3.5, raised $12 million in October 2023 to scale its open-source platform. LangChain's toolkit, especially its Langsmith module, reportedly reached $12 to $16 million in annual recurring revenue within a year. These startups share success traits, vertical focus, workflow integration, and lean agile structures that allow them to achieve $1 million plus ARR with small teams, bypassing the capital strain of training new models. D. Consumers and businesses. Finally, users from freelancers to global enterprises are the end beneficiaries. Integrating AI into their workflows, they automate tasks, enhance decision-making, and optimize operations. Even as generative AI passes the hype phase into a trough of disillusionment, Gartner forecasts that by 2026, AI functionality will be a standard feature in the majority of enterprise software. Number 3. Who's winning now? While AI model developers and startup founders gather headlines, the greatest and most consistent profits are being captured by infrastructure providers. Take Nvidia. As of July 2025, its market capitalization exceeded $4 trillion, the first public company to reach that milestone, and its Q1 2025 revenue surpassed $44 billion, with net income near $19 billion. And even when geopolitical restrictions affected GPU exports to China, approval to resume shipments, along with new hardware to comply with but maintain high performance, helped the company recover substantially. Meanwhile, AWS, part of Amazon, generated nearly $30 billion in Q1 2025 alone, underscoring that infrastructure is core to AI's economic engine. Number 4. Startups on the rise, building on top of AI. Newer players offer proof that innovation thrives atop established infrastructure. These startups avoid the steep capital costs of training proprietary models and instead build focused, useful products using APIs from OpenAI, Anthropic, and others. AutoGPT emerged in late 2023, raising $12 million to further develop a self-driving agent framework. LangChain or Langsmith provides a robust toolkit for LLM-based application development and rapid deployment. MindsDB enables database folks to leverage AI through SQL-based interfaces and has pulled in VC funding and enterprise adoption. Relevance AI and other B2B-focused builders underscore the lucrative nature of niche vertical tools. These startups share critical success factors. Number 1. Vertical focus, addressing sector-specific pain points such as compliance, legal, marketing, or finance. Number 2. Embedded workflows, fitting seamlessly into existing user processes, Gmail, CRMs, document workflows. Number 3. Lean structures, capitalizing on public APIs to avoid costly infrastructure investment. By 2025, many such initiatives consistently reach en route $1 million ARR with teams of fewer than 20 people. Number 5. The costs and challenges of the space. Although the upside is enormous, launching and scaling AI startups involves serious obstacles. A. Training and inference costs. Training flagship models is hugely expensive. Beyond GPT's $63 million compute tab, total R&D costs, including labor, energy, and trial runs, can surpass $100 million. If current trends persist, such training may reach $1 billion by 2027. Mid-size models remain costly. GPT-3 total costs reach $4.6 million. GPT-2 costs roughly $50,000. Inference, the process of gleaning answers from models, also adds up. Although per query compute costs are low, millions of requests quickly accumulate. Generative models used at scale can match or exceed training expenses and annual cost. Meanwhile, data centers consume substantial electrical power and water. AI's environmental cost is growing. Projections estimate AI-related training will use 85 to 134 terawatt-hours and generate carbon equivalent to hundreds of thousands of flights by 2027 unless sustainable design improves. B. Competition and market saturation. The AI app space is increasingly crowded. Standalone copywriting tools, analytic assistants, and vertical utilities are plentiful. To outperform, startups must deliver deep domain knowledge, excellent UX, and strategic marketing. Most rely on hybrid freemium or enterprise pricing structures that often stretch profitability and slow product market fit. C. Regulatory and compliance risks. Driven by privacy laws, GDPR, intellectual property rulings, fairness mandates, and transparency standards, regulation is mounting. Full compliance often requires legal counsel, auditing frameworks, and documentation systems. Smaller teams may struggle. Compliance spending can consume 40% or more of budgets in certain sectors, far above the 13% norm in generic software. D. Client trust and business development. Building enterprise trust takes time. Proof of concept pilots, certifications, and steady relationships. Many startups, even after relocating operations to the US, face elongated sales cycles and adoption friction. Number 6. How to benefit from AI without building it from scratch. If you're not in the business of model training, there are several meaningful ways to participate. Number 1. Support the ecosystem. Companies need specialized services, data labeling, sector expert consultation, UI/UX design, compliance oversight, and marketing. Firms like OpenAI and Anthropic hire domain specialists, especially in verticals like healthcare or finance. at higher rates than conventional crowdsourced labor. Number 2. Use AI within your workflow. Freelancers, small businesses, content creators, and marketing teams can deploy AI tools to automate research, optimize creative processes, or summarize documents. Many report marked productivity gains. With generative tools slashing manual hours by up to 50%. Number 3. Build API-based niche tools. Rather than risking $100 million plus in training expenses, lean startups use APIs to launch models-based assistants. You control usage costs per token or inference rather than capital expenditures, enabling scalable experimentation and product market validation. New techniques, including MIT's LEGO, are helping trim costs further, especially for smaller tailored models. Ultimately, the most sustainable route isn't to train a model, but to apply AI thoughtfully, matching generative capabilities to real-world pain points, embedding them into workflows, and safeguarding quality and trust, all within a scalable, compliant structure. What's your take on the AI gold rush? Do you think it's overhyped or just getting started? Let us know in the comments. And if you'd like more insights into emerging trends and wealth building strategies, subscribe to LuxFluent and click the video in the upper right corner. Get fluent, stay fluent.